Hello, everyone, and welcome to the second webinar in Fasken's 2023 Quarterly Perspectives on Tax Law Series, Business Succession Planning, Employee Ownership Trusts, and Intergenerational Business Transfers. My name is Kevin Yip, and I'm a partner in the Fasken's tax group. And I am joined by my colleague, Rahul Sharma, who is a partner in Fasken's tax group as well, and also in the private client services and wealth management group. I suggest if you would like to know more about us and our practices that you go online to the Fasken's website. But just so you have a bit of understanding about the context of our experiences, I'm just going to mention a few things about Rahul and then myself. Rahul advises international and Canadian clients on a variety of tax, trust, and estate planning matters, and he is particularly experienced with cross-border and international trusts and estate matters. As for myself, I have a broad income tax practice with expertise and experience in all domestic and international tax planning, corporate organizations, and mergers and acquisitions. I advise families, corporations, trusts on all domestic and cross-border tax matters. So our presentation today is we're going to be focused on two new proposals that were they were briefly mentioned before, but the details came out in the 2023 Canadian federal budget. The first one, then these two new regimes have, let's move this along. These two new regimes are relevant to owners seeking to transfer their businesses to the next generation. One of them relevant to business owners and founders who want to transfer their business to employees through an employee ownership trust. And the other one is relevant to founders and business owners who want to transfer their business to family members. The rules are also applicable to the purchasers. We'll be speaking from the purchaser side, the employees or the family members, but also these rules are relevant to financial institutions who may be interested in financing these acquisitions and the operations of such businesses. As you'll see as part of our discussion, funding is a very important topic that needs to be considered. And with that, I'm just going to pass this along to Rahul, who will start with the first part of our presentation.
Oh, thanks so much, Kevin. Just a quick note on budget 2023. I mean, budgets have always been fun. Budget day for tax lawyers is always, it's sort of like Christmas. You just never know what's going to be in that stocking when you wake up and reach into it. And I think that this was a fairly flat budget for the most part. And it wasn't a very exciting one. It didn't give us a tremendous amount to talk about. And it didn't have, it didn't have the oomph or pizzazz, let's say, of some of the of Finance's most recent announcements. Some in 2017 come to mind, for example. But the reality is there are two measures that Kevin and I sort of extracted from this budget, which are interesting and should be considered and taken a look at. There should be a little bit more light shed on them. And I just want to say the devil is in the details when it comes to this employee ownership trust. These proposals that their legislation was included in the notice of Ways and Means that was part of the budget package. So it's not very thick, but what you have in the materials, in the budget package, and in those proposals is detailed. And like I said, the devil's in the detail, and what always happens when legislation comes out, especially in tax, and it's so new, is you don't really know how to interpret certain things. And the more and more I looked at that legislation, and the more and more I looked at the proposals, the more questions kept springing into my mind. What about this? What about that? How are we going to do this? How are we going to do that? And maybe some of those questions are going to spring into your minds as well. We don't have all the answers yet, and that's, I think, part of the fun of doing this work, is that we get to find the answers and the solutions, and we get to take these positions and we get to work with clients. But long and short, these are two measures that we're talking about today that are fairly good news measures. They're welcome changes for the most part to our income tax legislation in Canada. Whether you feel that the employee ownership trust rules that have been proposed or introduced now have gone as far as they ought to have gone to enable employees to purchase businesses, I mean, that's a matter of debate. There is a debate still going that maybe they don't go as far as the rules in other countries do. But it is nonetheless, in addition to the Income Tax Act that didn't exist before, it gives new optionality to employees. And so it is, for that, from that perspective, a welcome addition and a welcome change to our income tax legislation. I want to pause for a second and mention questions, because we did, before even today, receive some questions in large measure from people who are joining us virtually today. There were a lot of questions raised that do not necessarily pertain to employee ownership trusts or to the intergenerational planning that Kevin's going to talk about in a few minutes. We have only a certain amount of time today. Unfortunately, we can only really spend today's presentation talking about the two topics at hand. That said, there's been some very interesting questions have been raised, and certain people have come out and said, hey, what about this? What about that? Could we talk about this? Could we talk about that? Certain other things that are related, but not exactly the topic of today's presentation. We've taken note of that, and rest assured, we are going to take that back, and it is likely going to be reflected in a future presentation that we do. In that regard, I actually thank everyone for bringing those suggestions forward and those questions forward. So with that, I'm going to launch into employee ownership trusts and to talk about this legislation and to talk about what this is and how it actually could be very effective and very useful for our clients, your clients, and the people we all work with. So we all know that employees are often the best people to whom the ownership and control of a business should be transitioned after the business owner's ready to retire, ready to leave, or when the business owner passes. You know, I was just mentioning over lunch a second ago that, you know, we do a lot of estate administration work, and every now and then in estate administrations, a business owner dies, and you look at this business, it's a small to medium-sized business, it's a very decent business, profitable business, and it runs on the power of its employees. Its employees know exactly what they're doing. They've been working at it for years. The business owner dies, and they still continue with the business. There are these 2 or 3 trusted employees. They're wonderful at what they do. They can carry that business forward. They can continue to keep it profitable. The problem is they don't have the money that that one would need to actually buy the business from the business owner, from the estate. And so the idea and theory behind these rules is to provide greater optionality in order to enable these employees to actually purchase and become purchasers of this business. And that's a good thing. And, you know, we were talking as well a few moments ago about the lobbying efforts that went in and the discussions that happened behind the scenes, behind this legislation to bring it forward. And the people who participated in that, who deserve a note of congratulations for bringing this forward, many of them were private equity people or ex-private equity people who saw private equity, who saw the options in the marketplace when it came to business succession, business purchases, and business transition, and realized that this was a major gap in Canada that was otherwise filled with certain legislation in other Western countries like the United States or the United Kingdom, and wanted to bring that sort of a model over into Canada. I don't know that they necessarily got everything that they asked for, but what they did get is these rules that we're going to delve into in a little bit more detail right now. So the new measures are going to take effect as of January 1st, 2024. Again, EOTs create another viable alternative by permitting businesses' employees to acquire and hold shares. Now, the idea here is that the EOT, I'll just call it the EOT for short, obtains debt financing in order to purchase shares. And the loan can be repaid over time, theoretically using profits generated by the business itself. So, structuring EOTs, you're going to need these following steps. Trustees of the trust negotiate the terms and conditions relating to the purchase of the shares of the target business. A trust is settled to comply with the EOT governance conditions, and the employees of the target business are made beneficiaries of the trust. Now, we looked at this legislation carefully, and Kevin and I had this discussion the other night. Do all of the employees need to be beneficiaries of this trust, or could it be certain of the employees? And the way that we read it, it doesn't necessarily say that every single employee of the business needs to be a beneficiary of this trust. Now, that might be right, that might be wrong. We'd have to see it in greater detail, but this is all part of this evolution and what we're seeing. So it's interesting. Another question came to my mind as I was reading this legislation, and when it was first proposed, what about unionized work environments? How is this going to work in a unionized work environment? And my mother spent her entire career negotiating with unions, and I just saw her coming home every night with less hair. Don't tell her I said that. But the reality is, she would be pulling some out. It was tough. It was a tough job, and the reality is, how is this going to work? Where you are now having to negotiate terms and conditions in a workplace. I'm not a labor and employment lawyer, but thoughts start coming into mind where you are going to engage in this planning. You're going to need the support of probably a variety of legal professionals and a variety of professionals in general. You're going to need, obviously, tax support, but likely you're also going to need labor and employment lawyers. You're going to need corporate lawyers. You're going to need a variety of people to help you set that all up. Obviously, here at Fasken, we have all of those groups, but the reality is you're going to need a team on your side, and the employees themselves are also going to need a team on their sides. And so all of a sudden you look at it and you go, okay, well, hold on a second. This is actually more complicated than it actually looks. There's a lot more to this, and that's what I mean when I say the devil's in the details. Debt financing is arranged in order to finance the purchase of the shares, and then the trust repays the debt over time using earnings. So we have this handy dandy chart. Thank you to Kevin for preparing it, where we've illustrated this transaction in effect. Now, we have an arrow here for third-party financing. Third-party financing can be obtained. It doesn't need to be obtained necessarily. You could take a shareholder loan from the target. And we're going to talk in a second about how the rules regarding shareholder loans have been relaxed in order to permit employee ownership trusts to be put into place to fund the acquisition of the company over time. So what is the employee ownership trust? The definition has been added. It's an irrevocable trust that is at all times resident in Canada. Now, importantly, it is not a deemed resident trust. So you cannot establish a trust in another jurisdiction like the Bahamas or Barbados or whatnot, which would otherwise be a deemed resident trust because of contributions coming from Canadians under Section 94 of the Income Tax Act. A Section 94 deemed resident trust will not qualify for for the requirements as set out. All or substantially all of the fair market value of the property of which is attributable to shares of a qualifying business that the trust controls directly or indirectly, and which is exclusively for the benefit of individuals who are the beneficiaries of the trust, all of the beneficiaries of the trust must be employed by the qualifying business. So right in the definition, we have key ingredients for what this trust needs to look like. So let's break that out. Again, needs to be a Canadian resident trust, has to have only two purposes: holding shares of a qualifying business for the benefit of beneficiaries who are employees of the business, and distributing business earnings to the beneficiaries subject to a distribution formula that may only consider length of service, remuneration, and hours worked. So that's the blanket model for just about every business in every industry that's going to take part in employee ownership trust planning going forward. Needless to say, there's a lot that's coming out of these considerations. So how are you going to determine distributing business earnings? How are you going to determine that formula? Obviously, under the basis of negotiation and discussion. The EOT must hold a controlling interest in the shares of a qualifying business, which would include a business in respect to which all or substantially all of the fair market value of its assets are attributed to assets used in an active business carried on in Canada. Essential again, there could be many businesses, Kevin, which frankly, Canadian businesses, but operating globally, or global businesses with significant Canadian presences or whatever. Those aren't the businesses we're talking about. We're talking about businesses where the assets used in the active business are carried on in Canada. Substantially all of those assets. All or substantially all of the EOT's assets must be shares of a qualifying business. Only qualifying employees may be beneficiaries. And, this is interesting, the beneficiaries of the EOT will need to elect qualifying Canadian resident trustees once every 5 years. So who qualifies? Individuals resident in Canada qualify. A trust company would qualify as a trustee. So, thought and consideration has to go into who would actually want to be a trustee of this trust. Would trust companies be entertaining this? I haven't heard very much activity in that, in that arena yet, but it could be that this is taken up as soon as these rules become live come January 1st. Yes. I don't believe so. No, it has to be Canadian. The requirements are for Canadian residents. So, and if you think about it, a non-Canadian trust company also risks taking this trust outside of the Canadian tax system, which would run counter to the to really the idea and the purport of these rules. So EOTs will be generally taxed as a personal trust is taxed, except they will not be subject to the 21-year rule. So those of us who do a lot of trust work know what the 21-year rule is. Every 21 years from the date of a trust's establishment, the trust property is deemed to be disposed of and reacquired at fair market value. So that deemed disposition and reacquisition will not apply. So the provisions of 104.4 of the Income Tax Act will not apply to employee ownership trust, which is good. Capital gains reserve available on the disposition of qualifying business shares to an EOT will be extended. Presently, if you sell shares over or sell property over, generate a capital gain, you're entitled to a reserve for capital gains tax purposes of up to 5 years, depending on the terms of your sales arrangement. That has been extended for the vendors of the business over to the EOT from 5 to 10 years. The repayment period for amounts loaned by a qualifying business to an EOT to fund the share purchase will also be extended from 1 year. This is under Section 15 of the Income Tax Act. There's a new provision that's going to be added to Section 15, which will extend that period. The income inclusion that would otherwise be applicable will be extended from 1 year to 15 years without 15.
15?
Yeah, without 15 sub 2 applying. So that's a fairly generous period of extension. Now, query, during that period, you need corporate profits to repay that loan. So just think about that one for a second. There's a lot of variables to the equation that aren't actually written out in the formula. Otherwise, except for those exceptions, your employee ownership trust will be taxed in the same manner as trusts are generally taxed in Canada, meaning taxable at top marginal rates for its province of residence. Here in Ontario, as we know, that's a fairly measly 53.53%. So you're permitted, that was a joke, by the way. You're permitted a deduction with respect to income distributed to trust beneficiaries. So the same principles, 104 sub 6 and 104 sub 13 will apply. And you'll need to adhere to those same principles of making sure that the amounts made payable to beneficiaries are actually made payable to them or paid to them in order for the trust to take the deduction. All those same rules, all those same principles, all of that will still apply to the EOT. Certain income earned by the trust will again retain its character. Dividends, for example, will retain their character as paid out, and those elections under 104.19, 104.20, and whatnot will still apply. So the same framework that we have for trust generally will apply, except for the exceptions that I noted earlier. And to answer your question, trustee must be resident in Canada. And again, the trust cannot be a deemed resident trust. Must be elected by the beneficiaries for a period not exceeding 5 years. And again, it could be an individual or corporate trustee that is a licensed trustee under the Loan and Trust Companies Act. So, governance. When an existing business is sold to the EOT, individuals and their related persons who held a significant economic interest prior to the sale will not be able to account for more than 40% of the trustees of the EOT, directors of the board of corporation, or directors of any qualifying business. So these are the requirements. Permitted beneficiaries, a new definition has been added, and that is a qualifying employee, and these would include all individuals employed by a qualifying business and any other qualifying businesses and controls other than employees who are significant economic interest holders. Interestingly enough, also employees who have not completed a reasonable probationary period, and the line in the sand for that probationary period has been drawn at 12 months. So they would also not be, if you're in the probationary period, whatever that is, up to 12 months, you're not a qualifying employee. Individuals, related persons who hold or held prior to the sale to an EOT a significant economic interest in a qualifying business would also be excluded. Interestingly and importantly, beneficiaries must be treated in a similar manner by the trustee. This is a trust. So even though there's an income tax framework that applies to the trust, it's still a trust, and that trustee is still a fiduciary. That trustee still has the fiduciary duties and obligations towards each and every beneficiary. Now, there's going to be a trust instrument that's going to be different from what a family trust instrument looks like governing the EOT, and that will govern the framework of the trustees' decision-making in many aspects and the role that they occupy. But they are still fiduciaries, and that's an important point to underline. Any distribution to beneficiaries must be based solely on hours worked, pay, and/or period of employment. So again, that's part of that formula, that's part of that determination that needs to be determined and then baked into this. EOT cannot distribute shares of a qualifying business to any beneficiary. So EOT is going to be required to hold a controlling interest in the shares, and all or substantially all of the EOT's assets must be shares of the qualifying business. Again, qualifying business would need to meet certain conditions, including all or substantially all of the fair market value of its assets are attributable to assets used in active business carried on in Canada. Similar rules that we see, or similar language that we see in relation to qualifying small business corporation shares when you're going to get the lifetime capital gains exemption. So we know that it generally means 90% or more. Qualifying business must not carry on his business as a partner or partnership. And, a qualifying business transfer occurs when a taxpayer disposes of shares of a qualifying business for not more than fair market value. Shares must be disposed of to either a trust that qualifies as an EOT, meets those requirements that we spoke of about 5 minutes ago, or to a corporation that is wholly owned by the EOT. So the EOT can form a holding company that will be the vehicle that owns the shares, as long as it is a wholly owned holding company. Again, the EOT must own a controlling interest. So some perspectives, and Kevin, feel free to jump in as well in terms of your thoughts on this. This is again fairly good news legislation. Retiring business owners can also benefit from the potential preservation of their legacy, preservation of what they actually built, and have it carried through to the future and have it grow potentially in the hands of the employees who come in through an EOT to make this purchase. This is good, and you can help, you can Potentially by selling to your employees, you can avoid selling to a competitor.
I think that one of the most important things is it just gives everyone another option, right? Like it's not like the U.S. private equity fund is the only game in town, right? There's like another possibility of having your employees participate and actually, and actually seeing the fruits of their labor. And it also the structure is flexible enough that there could be. There could be private equity involvement. There could be other people involved too, but that it gives the opportunity for employees to have a piece of the pie, and I think one of the policy reasons is that we want I think the government is trying to give an opportunity for the business to stay with the community, right? Stay with keep the same employees, have the profits of the business, stay with the community, stay with the employees, which I think is good policy. It's another option, right?
And we also have to remember that employees generally, in many cases, especially long-serving employees who help to build a business, take great pride in their work and what they've done. And this is a means to help facilitate those employees to get satisfaction out of becoming business owners themselves when a transition occurs from a business owner selling out, retiring, and then having those people who have been so instrumental in the business taking over. But again, will an EOT transaction be less contentious than another third-party sale? Easier to sell?
We're just talking about this. When we're preparing for this, it's like we're trying. Obviously, this hasn't happened yet or before. So we were trying to think about, what the dynamics of negotiation would be. Would it be easier, the same, or different as a typical purchaser we would see now? Again, like a competitor or a private equity fund. We're not sure, I guess. But I think what it does mean is that there will be someone will have to represent the employees. Someone will have to represent their interests. So maybe they'll need to have their own advisors, tax, legal, financial advisors as well, in order to make sure this this works for everyone.
So there could be quite a few lawyers and quite a few law firms at the table when one of these transactions goes down. And so just think about it practically for a second about the costs associated with that. And don't get me wrong, I love it when people pay legal fees. But the reality behind that is, there's also an element of practicality here where a business owner may sit back and say, yeah, but that's really complicated. And there's a lot involved to that. And next thing I know, there's going to be these guys, lawyers, and we're going to have to go and get a trustee, and they're going to want this, and then we're going to have to do that. Great idea. This is going to cost me a lot of time, money, and aggravation and effort. Also, are they going to pay me what private equity is going to pay me? Are they going to pay me what a competitor or someone else in this business is going to pay me? And so a rational vendor would probably have all of those thoughts go through their mind.
So that's kind of relevant to the next slide, right? So theoretically, it has to be based on fair market value, but again, if you're selling to a private equity fund, maybe or competitor, maybe the founder would just rather just take the cash and run, right? And maybe, whereas under the structure, where is the money coming from, right? It's either coming from debt or it's coming from the company itself. So there's additional credit risk. The founder has a they need the company to survive and do well, or at least do okay to be paid, right? Yeah.
There's also this extension to a 10-year payment window. Also means that you're potentially taking tranches of your payment over a lengthier period of time. If someone is able to come in one fell swoop, give you the same amount on day one, and not broken over 10 years, and again, a rational person might say, well, okay, if those repayments are partially contingent on economic performance or financial performance of the business, then we're baking in quite a bit of risk here, are we not?
Yeah, there's credit risk that would not have been, that might not have existed in a different type of deal.
I mean, from a lender's perspective, the EOT cannot contribute its own money for the purchase, so it's going to have to find the resources, the funds, to finance this sale in some other manner, either third-party financing or actually borrowing from the company through the shareholder loan mechanism, and then using that 15-year repayment period. Again, there's risk built into that too. That's not a completely easy model. And then what happens at the end of that 15-year period? You have an income inclusion.
And what happens if you can't afford to pay? Sorry, go ahead. Oh, sorry, can you wait for the mic?
So question, if we're going on the premise that the employees could be potential purchasers of a viable business or as a going concern, but from the vendor's perspective, there are all these other alternatives that they can review before they even get there. If the employees are already, needing money, how do they form a consortium and get that kind of money to even play ball in this field, to be a real contender for a vendor?
So, we were thinking about that too for the past couple of days. So like you're right. So like if the employees get together and they have to have their interests represented, like where do they get the money to start this or even start thinking about this? This structure does require someone to back them, right? So it may be like in our ideal situation, or maybe the situation that everyone imagines, it's the vendor that says, well, I'm going to sell to different people, but to truly canvas the market, I'm going to see if I can help the employees set something up. Not really sure where the money, like where the cash might be coming from in order to set the things up, but it really does require the vendor to come in and say from the beginning, like, I want to, this is an option that's viable to me. It helps everyone, right? Can you guys get together and get something going? There could also be other parties that back the employees too, right? Like there could be like other, not necessarily financially, strategically. There's opportunity for other market players to come and gather the employees together, and once we've done a couple of these, everyone has done a couple of these, hopefully it'll be more straightforward and there'll be a precedent and it'll be less costly to implement. Sorry, microphone. But hopefully it's, that's kind of how we see the dynamics playing out in the short term and in the long term.
Okay, and sorry, you can throw me out of this seminar anytime.
No, please go ahead.
So, the other thing is that when the employees do purchase this viable business and the vendor has to live for 10 years, I mean, is there an actual survey? Because by the time these vendors want to step off, they're 80 years old already, right? I mean, this is my line of business, but where is the viability of them surviving the 10-year period? Is that being factored in?
Well, those are the maximum numbers. So again, like kind of like the first, like in our structuring the EOT, the first step was negotiate the terms and conditions. So like it depends on all that's part of the particular deal and the structure, and it should depend based on the age, the vendor succession planning, like sources of financing. Like what we say, like I guess it's the side or the previous side, right? Yeah. Like you got to figure out where the money comes from, right? Is it coming from the deferred purchase price? Is the vendor selling, like lending? Is it coming from the company? Does the vendor want to wait 10 years? Maybe they want it to be paid off sooner than that, right? So it is a money question, right? But it's all part of the whole, like finance and governance, which we're going to talk about next soon. Those are the things that are going to be different in every deal. Right.
Yeah. I mean, to your point, a business owner who's 82 years old selling his business, wanting the money right up front, this may not be the solution for that particular individual.
About the business that they do want to give it to the employees, right? I mean, just say the scenario is that. Could it then pass down? Could those payments still be made across the 10-year period to go down to family members through his estate, his or her estate? That's viable?
Yes.
Okay.
Yes. So the key is, do they want/need all the money up front, right? Like maybe they're sure going to get their value, but like if they can defer the purchase price, they can pass it along to their successors.
So again, this one's interesting. Kevin and I discussed this one as well, and the reality is, your EOT in many ways is your controlling shareholder, and so you need to, and you're electing representatives of your controlling shareholder effectively to control for you, and so this could give rise to a little bit of politics at that level, and that might be interesting. And again, we haven't done this yet. We haven't seen this yet, so we don't know where this can go.
a lot of the thinking in modern corporate governance, I know a lot of lawyers, especially in Canada, have been talking about all those principles will apply here, right? So when we set these up, we'll definitely, Rahul talked about labor and employment lawyers, but we need to bring in corporate governance experts, right, in order to kind of set these up, especially in the early stages.
And absolutely, and there's going to need to be agreement on who your trustee is going to be as well. Or, there's going to need to be a vote, and there's going to need to be candidates. And so there's a lot of discussion involved in this. And it'll be interesting to see in a real life scenario how that discussion will play out, who the candidates will be, and how this will develop. And the industry, frankly, that will develop around it. Because I suspect that there might be some industry players who orient themselves towards EOTs and find solutions to more practical solutions to some of these issues that we're identifying right now. We're at least probably a decade out from that actually happening in real life, though. So that's just the way that these things go. I should mention, and I'm mindful of the time, we should probably move forward now to our.
I think we can just do drawbacks really quickly.
Sure.
Do you want me to? Okay, so I mean, one of the as Rahul said in the beginning, it's a very useful and important addition. It gives more options for vendors. Some of the flaws, I would say, maybe that's too strong a word, that might discourage the use of these include that the vendor, the vendor can't control the business. It's one of the requirements. So put that along with the credit risk that we talked about, right? Like, are there going to be founders and vendors who are maybe nervous about the structure? In other jurisdictions, perhaps some people are saying that this structure isn't as tax friendly, as tax advantageous as other structures in other countries. For example, other countries have like a capital gains exemption, whereas here, you could still get the regular capital gains exemption, but it's the other. It's not as there's an extended deferral. It's not as generous as as some of the other jurisdictions. And one of the things that Rahul mentioned in the beginning too, it's like this. There's a lot of Canadian companies that do have that aren't just all or substantially all business. Not all of their businesses not all or substantially all of their business in Canada, right? There's a lot of companies that have U.S. operations in other jurisdictions. It's it's a similar issue with the lifetime capital gains exemption and the QSBC requirement, right? Like we're trying to encourage Canadian companies to go out there and conquer the world. But so if that's the case, then why are Canadian rules really restricting that, right?
Especially when we sit where we sit, and the market just an hour south of us is so many more times our size and so much more appealing. And Canadian businesses are encouraged to go out there and to generate the profits in that market. It does seem like an interesting discussion topic for another day. But we're going to move. I think it's best we jump ahead. Just before we leave the EOT topic, of course, there are technical tax issues here. There are going to be some issues that have to be explored. I want to. Yeah.
But just so I'm clear, this is a trust that at the end of the day, the employees really never become the owners of the business. So once the debt is paid off, it's a means to provide economic benefits to employees from the profits of the business on top of their salaries and everything else. But
Correct.
the employees never become owners.
Correct.
Yeah. Okay.
Yeah.
It's probably
So-
not as useful a technique from some respects than I think was initially made in the public.
Exactly, and that goes back. I think that's a really good point, Karina, because that goes back to the lobbying effort was made, the pitches were made. I don't know that necessarily everyone who made those pitches got what they were asking for to the entire extent. This is what we got. It's it's good. It adds optionality. It's not necessarily for everyone, but it's interesting to understand what it is.
Karina's question just kind of skipped the slide, but Karina's question is relevant to this whole. I think we were thinking about Samai, you set this up, it's going well, they're paying everyone off. What happens after, right? Like, what are the restructuring options? These are details that need to be worked out. Can you distribute? Well, you can't distribute the shares out. So what happens? You have to sell the business, and then the cash goes out. It's not, or you're stuck with the structure forever, right? These are all questions that really need to be answered, because it's like, what happens 10, 15, 20 years from now, right?
We are at Fasken developing and studying it, developing trusts that will comply with the rules and these requirements. Big shout out to Maureen Berry, our partner, who is taking a lead on that. And I think Chris Steves is here too. And I think Maureen is working with you, Chris, on that. So, we're developing the expertise in this area, just like many of the other firms. And so we have all that it takes and all that it needs to help set these up come Jan 1, 2024, when the rules go live. So, do contact us in that regard, and we can help you with this. But I'm mindful of the time, so I'm going to pass it over entirely to you now, Kevin.
So to understand the new rules for the intergenerational business transfer, I think we need to understand or perhaps review what the issue is and what the rules are trying to solve. So I think it's, rather than, I skipped a couple of slides, but I think we're going to start here and just look at what a typical acquisition, a share purchase looks like, right? Let's pretend it doesn't say child. Let's just pretend it's on the top there. Let's pretend that's just a stranger, like an arm's length person. So normally, you have the subject corporation down there. That would be either holding company or the operating company. That's the corporation that has all the business. And then the vendor wants to sell the business. And then so a purchaser comes in. So typically, not always, but typically, the purchaser would be a corporation. If it's a non-resident, we would definitely advise them to incorporate a Canadian company. Even if it were Canadian residents, we would. There are a lot of good reasons to have an acquisition company as well. One of them being, that's where the money is. The purchaser company can borrow the money, and then they can amalgamate with the subject company to put the debt and the operations in the same place. If it were, now let's change this up. Now let's change it to the situation where, if it wasn't a stranger but a child, right? Like the vendor wants to sell the business to his or her kids or grandkids, or under these rules, the nephews or nieces. They would typically do the same structure. They would have a purchaser company for all the other reasons that I mentioned in the arm's length context, but also one additional reason. Where does the child get the money from, right? And so if the child didn't have a purchaser company, they would, they'd have to get the money from they could borrow the money, but perhaps maybe the money really is from the parents, the vendor, right? So that causes a problem, right? Because if the money comes from the business, the subject company, it had to be dividended out to either the vendor, or maybe you can time it. So after the acquisition, the subject and purchaser are amalgamated, so then that's where the money comes from. But the fact that you're taking money out of the company to an individual, right, that causes, that's kind of really why it's ideal to have the child or the next generation incorporate the company. The problem is this: before the rules that came out this year, and before an intervening rule, which we're going to talk about, the problem is 84.1. Actually, I should stay here. Under 84.1, the issue is if purchaser company buys the shares from the vendor, and then the vendor does not act at arm's length with the purchaser company, and in this case, we're not going to talk about any share consideration. Let's say it's all what we call boot or non-share consideration, any purchase price, cash note, that's a deemed dividend. If it were an arm's length purchase, that would be capital gains treatment, should be, assuming it's capital property, and it would, assuming the company qualifies, they may be, the vendor may qualify for the lifetime capital gains exemption as well. But if it's a deemed dividend, it's basically twice as much tax, and you don't get the not including the lifetime, the not being eligible for the lifetime capital gains exception. You can read the specific rules on your own time. So so people didn't like that, right? So then there was a private members bill that came out that was introduced to facilitate, kind of deal with that issue, right? And so what Bill C-208, which we still call, so under those rules, the 84.1 doesn't apply if the subject shares are a qualified small business corporation share or the shares of a qualified family farm or fishing corporation. And these two are the interesting parts. The purchaser corporation is controlled by one or more adult children or grandchildren of the transferor. And the third condition being the purchaser corporation does not dispose of the subject shares within 60 months of acquiring those shares. So basically, the policy behind this bill, and it was a private members bill. So there was some, when it first came out, there were some issues with people. There were two things. People were worried that finance didn't support this. Could we actually rely on this? They had certain dates that were coming out where the Department of Finance would say, okay, you can do it until this time, but we can't guarantee that these rules would apply after that. So there were rushes to kind of implement these transactions. So there's a lot of uncertainty here, right? Because I guess the point being that the Canadian government finance thought this was a bit too generous, right? Which they repeatedly mention. And so in Budget 2023, they wanted to make sure that they had additional conditions that favorable the favorable treatment, basically 84.1 not applying, this deemed dividend not occurring, actually only applies to what are called genuine intergenerational business transfers. So they did that. That's what they did. They introduced these rules that are tougher to meet than Bill C-208, but still have the opportunity to avoid or mitigate or be exempt from, I guess, 84.1, where you're essentially transferring your business to your children, your grandchildren, your niece and nephew, your grandniece and nephew. I'll get into that. So it's essentially, you need to think about there are these rules. You need to think about it in terms of time. There's rules that apply before the disposition, at the disposition, and after the disposition. And the rules after the disposition, the parties can actually choose to go one of two tracks. So it's a little bit more confusing to begin with, but I think I'm going to try to kind of illustrate the differences, which may make it easier to understand. So just so it's more easily understandable, I have a chart here that kind of sets out the different definitions that are used. So this kind of looks similar to the 84.1 example. There's a child with a purchaser corporation, and when I say child, it includes nieces or nephew, which is not the normal rule, right? So it was a policy decision to kind of broaden the people in the next generation who can benefit from this. And then we have the subject corporation, and then everything is going to be based on something called disposition time. So disposition time is just when the shares are sold. And certain things have to happen at that time. So again, so spouse includes common law partner, disposition time. In the chart you saw what was a relevant group entity and relevant business. And it's QSBC shares and QFFP a qualified small business corporation and qualified farm and fishing property. So the key concept is disposition time. So before the disposition time, the vendor, together with the spouse, they have to de jure control, legally control the subject corporation. So they have to, de jure control is they have to have the ability, subject to like USAs and things like that, they have to have the ability to elect the board of directors or control the board of directors. They have to have control, and there's no one else that can have de facto control. At the disposition time, this is only available to an individual, not including a trust. The purchaser company, right, that has to be controlled by one or more adult children. So this obviously only works for when you transfer it to the acquirer, has to be a child, extended meaning a child. And this is one of the requirements too. There have to be after the disposition time, they have to not own or directly own more than 50% of the shares of the subject corporation or the purchaser corporation or those underlying subsidiaries, the RBs and the RGEs that we're talking about. There are certain, they kind of look like free shares, but they're actually, the dividend rate is has to be the prescribed rate. There's certain non-voting preferred shares that the vendor can take back, so they can still have like an economic interest, just not voting interest in the subsequent company. So then, and then within 36 months, so within three years after that, then either the vendor or the spouse, they can't own or directly or indirectly own any shares of the subject corporation or any equity interest in the RGV. Again, there's an exception for the for those special non-voting preferred shares. So if the common requirements are met, then you either go the immediate way or the gradual way. And if you think about it, the immediate way is like kind of a 3-year time period. The gradual transfer it's between 60 months, 5 years, and 10 years. So under the immediate transfer, going through this quickly, the vendor doesn't control the subject corporation, the purchaser corporation, and there has to be a transfer of management, right? Before we were talking about like legal control, there has to be a transfer of management. Within 3 years, there's also room for like a reasonably longer period. And this is important too, right? The kids have to control and work in the business. There has to be at least an active child that works in the business for 3 years. And well, that's it. For the gradual business transfer, it's almost the same test, but in this case, they can have the vendors can have de facto control, but they can't have de jure control, and they have to transfer management to the active children within either the later of the 5-year period, or within a 5-year safe harbor or reasonably longer period. But here's the interesting part: within 10 years. They have to reduce their interest in the subject corporation and the purchaser corporation and any relevant group entity or business to below a 30% fair market value percentage threshold if it's a QSBC, or 50% if it's the farming or fishing company. And this is what's called the final sale time. And so then the children have to work. At least one child has to work in. And they have to retain control of the business, until the later of 60 months after the disposition time or that final sale time that we just discussed. So there's a bit more leeway to time there, but they have to have at least 60 months. They have to at least control and work in 60 months. I feel like that's maybe the hardest thing to make sure it works, is making sure at least one child works there for 6 years. If the rules apply, then kind of like the EOT, the capital gains reserve is extended to 10 years. There has to be, in order for this to work, there has to be a joint election. So they need to know that they're walking into these rules. The joint election with the vendor and the children, it makes the vendor and the children jointly and separately liable for if the 84.1 applies, turns out to actually apply because perhaps they failed one of these conditions. The normal reassessment period is extended. Obviously, that's very important for like the 10-year, the gradual business transfer, right? Because then, because it's possible for the rules to, for one of the conditions to not be met after what would typically be the normal reassessment period. So again, just some brief comments on this. It's interesting because C208 those rules still apply. January 1st, 2024, these new rules, assuming it's passed, these rules kick in. It's good that there's certainty. There's rules that that are blessed by the government. So there's certainty that assuming it passes, there's certainty without change. There's certainty that that the taxpayers can rely on these rules. It broadens the eligibility to a broader class of persons, nephews, nieces, nephews, grandnieces, grandnephews. So all in all, it's very good. In terms of just some practical tips, imagining how to make sure that the rules are met or the conditions are met, I guess we're imagining like a really detailed shareholders agreement, right? Like I think the only the timing, the requirement to dispose of shares or seize control at certain times, that can only be done through some sort of contractual arrangement. A USA is probably the best way to do it. Again, I was thinking about what those conditions might have in there. It seems like the only thing is like making sure at least one of your kids stay, right? So like I don't know if you can actually, I don't know how you can contractually force someone to work there. So it's kind of it's interesting to see what they'll do about that particular rule. But again, this is certainty is good, and this is the theme of this presentation, and this is one more way that founders, business owners should think about when they want to exit the business, think about succession planning. Right. So I think this is the question period. Does anyone have any questions?
It doesn't need to be just questions. If you guys have comments
from your experience
as well, from your experience, any thoughts to share, we'd welcome those as well.
Go ahead.
The preferred shares that you mentioned in the second arrangement, can those be redeemable preferred shares? So over the course of time, you can get the previous owners out of the relationship?
Yes.
Okay. Perfect. Thank you.
A couple questions from the web, if you'd like.
Sure.
All right, so we do have one question here from one of our webinar viewers is about the EOT, and would you recommend that members of the EOT have a shareholders agreement? And if so, how would a purchase and sale provision be treated?
So that's interesting because, I mean, Kevin, I think we talked a little bit about this, that your EOT, and this goes to Karina's point as well, is your controlling shareholder, effectively. So the terms of ownership and how profits and whatnot will be allocated effectively once that EOT takes control of the business are going to need to be baked into that EOT effectively, or the terms of that EOT. And that's where your discussion is going to have to take place. And so that's where the employees as a whole or as a unit are going to need to come together. Underlying that, the corporation can also have a shareholders agreement. This is part of the interesting jigsaw puzzle that this is going to create a little bit for everyone, is figuring out how we're going to make those two work now together. There might be a need for amendment. It's a good question because there might be need for amendments down below to now reflect the reality of ownership by an employee ownership trust. I don't know, Kevin, if you have any other thoughts there.
Yeah, that's right. So like a lot of what you might see in a shareholders agreement would be in that trust indenture, only in the sense that because the employees aren't owners, but I guess you're imagining them to be kind of like owners, right? So those types of ideas or concepts or protections are in the trust agreement. So when we're talking about the negotiating the terms and conditions, right, and then or fiduciary duties, it's all that's kind of the document that has it. But theoretically, there could be other shareholders. So then, and if that's the case, then the trust indenture deals with the shares that are owned by the trust, but then the shareholders agreement deals with everything else, and that will just be the normal considerations that we would have.
It also goes to the point of complexity that we talked about. This is not going to be necessarily a simple arrangement. And as you have with shareholders agreements where different shareholders have different interests and are represented by different parties, same might actually end up happening in this kind of a context as well. So
yeah, that trust agreement is going to have to do a lot of things. It's going to have to deal with governance, voting, payments, salary, it just has to, how do we wind up? That's my question. What happens in years from now? I have no idea. It has to deal with a lot of things. Maureen's going to figure it all for us.
Well, I think the person who is tasked, or the firms that are tasked with actually preparing and drafting these EOTs coming Jan 1, 2024 are going to have an interesting time, and they're going to have stories to tell.
So does the employee own a capital interest in the trust? Would they be in a position to sell their interest and deemed disposition on death?
No. So it again, as I mentioned, the general conventions for trusts always will apply to these as well. So an employee is a beneficiary. A beneficiary always has a capital interest in a trust, and there are provisions in the Income Tax Act in Subdivision K that govern how those things are generally dealt with. But that's locked in. Right? So.
And only employees can be beneficiaries.
Correct.
So there's a limit
Correct.
to. And one of the things we're talking about was like, well, what happens if you're terminating an employee? What happens if you're like, what if you're no longer an employee, right? So like it's, I think, the first thing comes to mind is if you're not an employee, you can't be a beneficiary anymore. So there's probably going to be some, again, in the trust indenture or some other agreement. Like if someone gets terminated, you have to deal with those issues. Maybe you may still be able to get some benefit, some distribution just up to kind of like a retiring allowance type thing, like kind of up to the point of your, because I think it includes former employees. So like you can still get a distribution that kind of deals with a retiring allowance type settlement payment type thing. But again, these are all issues that we need to bring our corporate governance people, union experts, labor and employment experts to deal with.
It goes to the point where this trust is a massive undertaking and a large document, right? It's there's going to be a lot to this.
Okay, well, so I think we're out of.
Just one observation. You were talking about, and this is just something I've found through experience, is that you were talking about the Mr. Vendor, and this is in the employee deal, he's got, there's lawyers come in and all this sort of thing. But there are a lot of vendors who are frozen with regard to selling their business because they don't want to be seen as knifing their employees in the back. If indeed, I mean, they're not doing that, but that's how they perceive themselves, seeing that. So this actually can be seen as advantageous in a lot of cases.
It's absolutely right.
Owners,
Absolutely right.
So thank you. We're out of time for any further questions. Thank you for joining us today. If you didn't get a chance to fill out our survey, we would appreciate if you took a minute to do so. There's a QR code up there for it. I'd like to thank everyone for attending either virtually or in person. I'd like to thank the Fasken marketing and IT teams for helping us set this up. And just a bit of news, the next session in Fasken's 2023 quarterly perspectives on tax law will be in October. So keep an eye on your inbox for the invitation, and hopefully you guys can make that one too.
And enjoy the summer, everyone. Enjoy the nice weather.
Thank you. Good afternoon. Bye-bye.